Welcome to TheoTrade. This is Don Kaufman. May 20th, 2022. There are 14 minutes left inside of this options expiration Friday with market volatility once again just raging. In fact, we're going to talk about that in quite some depth. Obviously, the S&Ps here are hitting for the first time officially into what we would term bear market territory, which kind of begs the question that are markets on the verge of a crisis? We're going to look at some aspects of the market that absolutely are in, huge crisis. One of them being liquidity. And I'm actually going to take you through a couple of details on that here momentarily. Before we do that here, as we actually get into the weekend update, I want to just discuss a little bit about year-to-date recap of a couple of major sectors, and really that the terminology of oversold has just become utterly cliche. Because I don't care how many times in a row that you want to scream that this marketplace is an oversold territory. Listen, the S&Ps at this point in time, they cannot catch a bid, okay, to save themselves. I mean, effectively, we've been straight down since roughly, the beginning of April. I mean, I'm actually pointing here to ultimately to March 30th, but the S&Ps has been really straight down. I mean, we haven't had a bid back other than for what, a huge bid back onto the marketplace for 2 hours after the last FOMC announcement. A little bit of a bid back onto the marketplace before dropping up precipitously. If you take a look at the S&Ps today, I mean, it's been Mr. Toad's wild ride. And by the way, if you take a look where the S&Ps happen to be trading presently, is that a critical and or important level? You look at it and you're like, what's so important about 38.85? I'll tell you exactly what's important about it. For those of you that do tune in on a week-to-week basis or even day-to-day basis here, if you're watching TheoTrade, it's the lower edge of the expected move in the SPX. So in the midst of what feels just like absolute sheer and utter chaos, and you're like, oh, the markets, are they in the middle of, kicking off a crisis over here? All of a sudden you look at the S&Ps, which is, it's a $3,889 product. You're going to love this. When you go down to a 1 day, 1 minute, do you realize that we are literally to the penny on the edge of the expected move? You just can't make that stuff up. And it's a degree of efficiency inside of, a marketplace that just seems absolutely chaotic. We'll come back to that in a little bit. Let's actually talk a little bit about oversold, because it's just a term that I've heard continuously. Hey, this marketplace, it has to bounce. It's oversold. Eventually, you're going to come to the realization that an oversold marketplace, every time that it has bounced recently, there's more sell side into it. And that is simply, to put this kind of in context, there's a lot of people throwing the towel in right now, but they're throwing the towel in now on 401ks and IRAs, institutional money managers starting to actually unload positions. So in effect, what you're seeing is when the markets are, bidding back up, you're seeing people come out of the woodwork and they're like, finally, we got a little bit of a relief rally. We got to actually sell into it. Do not get me wrong here. We're going to have absolutely wild bear market rallies. For those of you that do not know this, some of the largest moves, some of the single largest moves that have ever happened on record are in the midst, of bear markets. And again, you can go back historically and take a look at that, but we'll have 2-3 day periods where the S&Ps could be up 2, even 300 points. But as of late, all we've actually seen is that every bid back onto the marketplace, it starts with a little bit of short covering, but eventually, listen, coming into a weekend, cover your shorts. People have had phenomenal profitability that have been short. Market making firms have just got, eventually you got to cover some of your delta, so they buy back some of the futures contracts they've been shorting. We explode higher. But what we haven't actually seen really at all is it's like nobody putting new money to work. So all you're in effect getting is short covering, that is sparking, the quintessential rip your face off rally. And every time we rally, unfortunately, portfolio managers and institutional money managers are stepping right back in. They're like, finally, it's a chance to get out of Tesla. Finally, it's a chance to be able to get out of this particular position. They're using it as opportunities to smack the marketplace back. So, this terminology of like oversold. Listen, I can pull up every technical you want over here. Look at the S&Ps in a 1 year. This is a TheoTrade RSI Laguerre. It's a Laguerre, polynomial, but ultimately we're in monstrously, oversold territory. I mean, every single product you look at, you want to look at the Nasdaq over here, oversold territory. But behold, pull it up on a even like on a 10-year weekly. Okay, some of the most hideously oversold territory that anybody has seen, really, in recent history. And at the same time, I'd say that as it's cliche. It just doesn't matter what you think. No one cares at this point in time as to what oversold happens to be. All they care about is self-preservation. And you better remember that from this point forward. And that's why I started asking that question, are markets on the verge of crisis? Because in the end, it does come down to self-preservation. If you're caught long right now in markets, okay, you're caught long in markets. Let's actually cruise over to the spiders for a second and recognize again, and I was talking about this last week, and I'm going to reiterate this particular thought, and that is you better stop looking at a 3-year chart. You definitely don't want to look at like a 1-year chart. If you are in technicals, you got to open up 10-year minimum. 10-year minimum, because the type of move that we're seeing right now, it's not a flash in the pan like COVID was. I think you just need to delete that, okay, from like, from what happened there, and recognize maybe even a 10-year doesn't do it. It's actually going to a maximum chart, okay? This is an extraordinary move that we're undertaking. This is not a move that's going to go away anytime soon, okay? And I'm reiterating this because in previous moves, I mean, you can see some of the devastation where, ultimately had 10 years that was undone, okay? Obviously to the financial crisis. Prior to that, you had many years of work that was undone. Ultimately, when the Nasdaq came undone, do I think that we're going all the way back here to 150? Absolutely not, okay? Just call me crazy here, but maybe we come back again to kind of pre-COVID levels. So to look at the marketplace and to scream it's oversold, well, there's a lot of indicators on the screen right now that would argue otherwise, and we're actually going to look at that. Before I do get into that, again, I just wanted to make the very simple argument that the term oversold is, it's not only cliche, it's absolutely unequivocally worthless at this point in time. Your technicals, throw them out the window. There's no levels that are going to make a difference, because when the volatility monster arrives, everybody runs for one door, and that door is the sell button. And unfortunately, there's only one sell button on any platform, and everybody goes for it at the exact same time. And again, it throws Fibonacci's and the Bollinger Bands. It's not going to make a difference. All right, remember that. Oversold is cliche. Next in the docket, you got to start looking at a year-to-date recap of major sectors. We'll start with the spiders. On a year-to-date basis, it's official. The spiders did actually hit, the S&Ps did in fact hit bear market territory. All right, so what does that mean? Absolutely nothing. The Nasdaq's been there for a considerable period of time already, when the Nasdaq's down almost 30% on a year-to-date basis. Okay, but again, a little respect for this. You open up like a 10-year in the Nasdaq, all right? That's, it's just skinning its knee at this point. That's over the last 10 years. It's still up 363%, but call me crazy if it was only up 200%. Well, okay, it's possible, it's absolutely plausible at this point in time, but you're seeing this is real damage now being inflicted. And again, I'll reiterate the point, okay? This is not something that's just going to go quietly off into the night and that you're going to be okay. You really have to consider, all right, long-term portfolios at this point, because that's what we've been seeing this week is outflows from major funds. S&P 500, you got to think like Vanguard 500, okay? How many redemptions did they see in a week like this? All right, onward and upward. So I was just bringing up, again, a year-to-date of the Qs, all right? But let's get really specific. Take a look at the financials. And here's actually some cause for concern. And the cause for concern is specific to different sectors that absolutely unequivocally matter, like financials. So financials, okay, are now down only about, we'll put them at 17%, okay, year-to-date. So why do I care about that? Do the financials have to get absolutely annihilated in the middle of any kind of market crisis? And the answer is, well, no. But they're probably going to be holding a very large bag of risk, okay, at some point in a particular crisis. And I argue the financials, okay, and I said this, last weekend, I said it on the Wednesday night video, but the financials, take a look at like auto expected moves here. I just want to bring this up. Financials here, they're not even at the lower edge of their expected move. And to me, there can be considerable downside inside of the financials. What you're actually seeing in effect, okay, is one financial in particular. This is actually a major constituent inside of the XLF. It's Berkshire Hathaway is actually flat on the year right now, and if anything, is actually holding the financials up at this point in time. 3 minutes left to play inside of the week. So Berkshire Hathaway could see some considerable sell side. How do some of the other financials compare? If you take a look at something like Wells Fargo, it's down about 18%. Take a look at Bank of America, it's down almost 26%. JP Morgan, down 27%. Nevertheless, the financials as a whole, the sector itself, could still withstand some serious sell side. Another aspect that should really resonate with you in terms of major sectors, you have to look at the energy sector. The energy sector is actually up some 42%. And it's a little bit disconcerting on this particular front because the energy sector, which has been just decimated, over like the last 10 years. Take a look, by the way, 10 years inside of the energy sector, it's only up 25%. The reason I wanted to recap this with you is for many, many years, a company like ExxonMobil, let's actually bring it up. ExxonMobil was one of the biggest monkeys in the market in terms of market capitalization. We actually go ahead and bring up this like phase scores and stock highlights. Do you realize, again, ExxonMobil is a $400 billion company? And why do I care? Because it's starting to get neck and neck with like NVIDIA again. And you're seeing the demise of tech. Again, when you start comparing that, and by the way, here's tech, that's 10 years inside of NVIDIA. I'll even knock that down to like the last 3 years inside of NVIDIA, still up 340%. Okay, compare it for a second again to ExxonMobil. It's not that ExxonMobil, okay, has done anything spectacular. They just haven't lost market cap. And all of a sudden, one of the more influential sectors becomes energy again. Think about the irony of that with all the green talk right now, that the energy sector, once again, is becoming one of the more influential. The reason I say you should definitely keep eyes on this is, again, if we bring up the XLE, and recognize that on a year-to-date basis, sub 42%, any sell-side activity in here, okay, you have to appreciate the fact that it's actually holding the S&P 500 up. And you're like, wait, the S&Ps you just showed me are down 20%. Yeah, that's correct. Nevertheless, okay, the XLE and the energy sector is actually holding it up. Again, a stock like ExxonMobil, as I said a moment ago, okay, knock that out here. Stock like ExxonMobil's got a $400 billion market cap, and you realize like stuff like Chevron, okay, it's got like over $330 billion market cap. Start adding a few of those up, and all of a sudden they start to rival a couple of the tech companies. Now, granted, okay, this is nothing in scope to, in the comparison to what Apple. So if we bring up Apple, it's at $2.2 trillion. There it is, $2.2 trillion. ExxonMobil still looks like a little peanut. That should actually be a warning shot being fired across the bow. Why am I saying that? Because what you're seeing right now inside of the broader marketplace, and it's why I'm actually doing a year-to-date recap of major sectors, is to get you to recognize that some of the major tech stocks that are being, everybody's pointing a finger. They're the reason we're selling off. They've only begun to sell off. The market cap is collapsing inside of, mega market caps, okay? Unequivocally, you still have, okay, quite a bit of magnitude in here. Coming to the closing bell. That's it for the week. So you're actually coming in to a market cap that's $2.2 trillion. Again, there's some damage inflicted in Apple, but it's not even back to where it started, for instance, to last year. So I'm just getting you, ready to realize that year-to-date recap of major sectors. Again, that term oversold has become cliche. You're starting to get a better feel. I'm not going to go too deeply into sectors from that point. All I want you to recognize is tech, okay, versus financials versus energy. Energy being up some 42% is actually holding markets together, okay? Tech, although weak, could get substantially weaker, okay? And it's specific to mega market cap. And yes, we're totally, completely oversold and we could bounce, all right? Or people could be running for the exits out there. But if we start to see weakness in an area like the energy sector and XLE, you're going to see some hideous sell side in the in the S&Ps, given the fact that energy is what's actually holding them up. All right, spinning this around a little bit. Liquidity. One of the areas that we really want to focus on this weekend's update here, our markets on the verge of a crisis, is there absolutely is a liquidity issue at this point in time. Liquidity is just non-existent in a ton of products out there. Okay, to point that out, and I was doing this a little bit on the throughout the course of the week, in TheoTrade. But if you look at like the S&P futures, which S&P futures, for those of you that don't speak geek, they drive order flow to the marketplace. The bids and offers in the S&P futures throughout the course of the day have been like really, really thin. There's not a lot of liquidity on the bid or offer. Nobody wants to make an incredibly tight market in an incredibly volatile market. Okay, to point this out, the indices are seeing this incredible concentration of liquidity. And that's even more alarming than not making really tight markets. When I say not making tight markets, don't start pointing a finger at Citadel and like Virtue and all the market making firms. It's not their fault, man. Okay. It's just the bottom line is there's market participants, but the S&Ps are so sketchy right now that nobody wants to make really tight markets, okay? And nobody wants to step out and take some huge risk and be like 100 up. And what I'm talking about with like 100 up, like nobody wants to come out there and be like, yeah, I'm 500 bid and 500 offered, okay? No one is stepping up to make those markets. I mean, here, the market's basically closed. Look, they're 100 up on either side. Throughout the course of the day, I saw as much as like there were like 6 offered, 3 on the bid. It's crazy out there. Super, super thin. But that isn't the point. I've already mentioned that a lot in the past. Here's the point of me bringing this up. Okay, liquidity is non-existent in many products, but on the same token, okay, it's absolutely massive in others. Everybody's concentrating now into a handful of products. Allow me to bring up the spiders for a second. Now I know this is a primary expiration day, meaning that it's OpX, right? I mean, option expiration. The May options, and that's the monthly options, have expired. And there's always huge, liquidity in there. But check this out. If you haven't looked at the spiders in a while, you ain't gonna believe what you're seeing over here. Okay, just take a quick glance. Yeah, the spiders today traded 10.2 million option contracts. 10 million option contracts. They only did 100 million shares of stock. We're trading 10 million option contracts, which is 2 times the norm, which again, it's phenomenally large. Wait, you go, well, why do I care about that? Let's get crazy because it's options expiration. Let's say that the entire market today probably did about 50 million. Okay, the whole entire marketplace probably did about 50 million option contracts. Yesterday, I think there was like 46 million. So the entire marketplace says 50 million. You realize that 10 million of that is spiders. Okay, so that's 1/5 of the entire volume. But wait, there's more. Okay, what's the more part? Well, that did 10 million. What's the SPX good for? By the way, the SPX is exactly 10 times the size of the spiders. The SPX is actually good for 2.6 million. The VIX is usually good for 700,000. There it is, 650,000. You look at something like the QQQ, okay? The QQQ is good for 3.5 million contracts. Do you see where I'm going with this? Everything that's really trading and trading heavily right now is inside the major indices. There's concentration of liquidity. It is alarming to say the least, because anything that's off like the beaten path, even stuff like XLF, and XLF, I mean, it's a major component, 335,000 contracts, like they forgot about it. I mean, literally, it's like they forgot about it. You go, let's pull up something like Caterpillar. Caterpillar had a huge move today. You have 42,000 contracts. They're non-existent. They're just non-existent. The only thing that matters right now are the major indices. Indices are seeing this huge concentration of liquidity. And what that is causing right now is, well, I'll make this brutally honest in here. We've got systematic and systemic risk because of it. Ultimately, what's going on inside of the marketplace is everybody from retail to market making firms, they're all trading stuff like spiders, they're trading SPX, and then they're slinging S&P futures against it. It's one of the reasons I actually commented on the S&P futures. Okay, nobody's on the bid size, nobody's on the offer. It's really sketchy out there right now with this kind of concentration of liquidity, because all of that option volume that you're seeing, you're like, well, how does it do that? And like, what's going to happen? So all the option volume you're seeing is just creating more and more directional risk being applied to the market maker firms. The more directional risk you apply to the market making firms, okay, the more they're going to have to hedge. The more they have to hedge, and they're going to hedge in the dynamic of the marketplace, this is exactly what you get. It's a one-way ticket, people. It's a one-way ticket to the downside, to the upside. It doesn't matter. Like, I'm not being biased with the conversation of we're going down or we're going up. Okay, the crisis in the marketplace is actually a crisis of liquidity, but even more appropriately, it's a concentration of liquidity. If you were to actually fire everything you had at one particular spot at one particular time, what's going to happen? I mean, it's basically going to like nuke whatever product that happens to be. Well, the product happens to be the entire marketplace. It's the spiders, is the S&P. And unfortunately, the amount of volume being done in here, okay, is alarming to say the least, because again, it is going to move what we term like, the gamma hedge, so forth. It's going to move markets. It's volatile, and it's hideous at this point, which actually brings the next question. So we're seeing this concentration of liquidity. You have a little bit of a bid back under bonds. I've noticed a lot of hedging activity just in the last couple of days, where traders now are rushing back to the bonds, okay, to actually hedge themselves. They're also rushing into the dollar to some degree to hedge themselves, not nearly as much, okay? But the reason I'm bringing this up is all of a sudden the marketplace turns around. There's this huge concentration of liquidity, right? People are now buying bonds to duck and cover. And then we come to one of the biggest issues. Volatility to me looks all kinds of wrong. Like, I'm not even going to sugarcoat this. Volatility is all wrong right now. Okay, what's wrong? Like, we saw something scary today. What was scary today? We actually the S&Ps broke through their lows. Okay, this is it, baby. We hit it. We're all the way at 3807 in the S&P futures. Okay, the last low was 3855, and then we hit 3856 earlier this week. Well, here we are. We hit the lows. The volatility hit highs? Nope. Okay, nothing. There doesn't seem to be fear and loathing. I'll tell you exactly why. A lot of the liquidity that's being traded, as I said, it's concentration of liquidity. These market making firms are just offloading all the risk inside of the S&P futures, which is actually spiraling the markets. Which, in effect, what I'm saying with this, when I say volatility looks all kinds of wrong, the VIX didn't do that much today. I mean, we didn't even get to the 34 level. We're going to have to see something absolutely unequivocally hideous. And I actually go back to the point where oversold has become cliche. You want to know why oversold has become so cliche? Forget about your MACD, your Fibonacci, or Bollinger Band. How about this? See that VIX spike into 40, 45. Okay, we need to get rocking. I mean, the volatility right now, it looks all kinds of wrong. It's not right for this marketplace. Again, so this concentration of liquidity is definitely problematic, because it's actually shoving risk, okay, down one very, very small hole, which happens to be spiders and S&Ps. Okay, the other aspect, volatility, it isn't raging, which tells me that people are still taking inordinate amounts of risk, because volume has been decent inside of markets. And we did 46 million contracts yesterday. We probably did 50, 53 million contracts today. So volume is there, but they keep packing more risk and more risk and more risk into one product. The only thing that's going to get volatility to have liftoff over here is an absolutely hideous move in the marketplace. And I'll actually finish that one off with, did you realize in the volatility futures, after everything we've been through this week, volatility is actually in contango. That means short duration volatility is actually lower than long duration volatility. Contango, one man's contango is another one's backwardation. But what I'm saying is, come on. We should be rocking, right? Nobody feels like their pants are on fire at this point, and you should, given the fact that the marketplace, at least in my opinion, okay, I saw some scary things happen today. I'll tell you the scariest thing I saw happen today. There was really no bid or offer, and the S&Ps were just selling off. Don't worry, they rallied back up. People, we don't have that capitulation, and that's what's scary about it. Contango in a bear market. The last thing I'll actually say on this front, forget about a bottom. You want to survive this marketplace? I am deadly serious with that. I've already had 100 emails. I'm going to sell puts in the S&Ps, and I'm going to buy me some spiders at 350. And I'm like, hey, man, you do whatever you got to do. But don't tell me that you think we're at a bottom. I don't care about 350. I have not a care in the world as to where you think the bottom happens to be. Okay? You're going to go out there fishing a bottom? Listen, 350 might be an awesome buy inside of the spiders. When we get to 350, though, you're probably going to think to yourself, 275 might be an awesome buy. Don't worry, I'll average down in here. It's too early in the process. Too early in the process. Again, we're seeing a crisis of liquidity. We've seen a concentration of liquidity. The volatility is still in contango on a year-to-date basis. Major sectors, it is all kinds of wrong out there in the marketplace at this point in time. Last but definitely not least, we look at the SPX, the mother of all products. You know why I want to bring up the SPX? Wait for it, wait for it. Look at the SPX. So the SPX in this past week, that's the week that just ended 11 minutes ago, the SPX was looking for, roughly speaking, $133 of movement, either higher or lower. What did we do? Hit it spot on. Even with the big, rip your face off rally that we just saw kind of transpire. I want you to see this is the lower edge of the expected move. Again, to put it into scope, that's where the week started. This is where we presently are, right? Let me clean that up for just a second. Look how close we actually finished the lower edge of the expected move. And the irony is that the S&P futures slid like 4 points lower, would have actually taken us right to it. I mean, we're on the lower edge of the expected move. So we hit the lower edge of the expected move, which means like volatility is raging in the marketplace, but it's not. And that's exactly why I wanted to bring this up. Because the expected move in the next week of trade, which I don't even have listed in here yet, but the next week of trade, you're looking at about $128 expected move. And you go, how is that possible? We just saw, let me say this eloquently, hell in a handbasket of a marketplace. Okay, people are a basket case rocking and back and forth underneath their desk at this point in time, right? And at the same time, volatility actually went down. The VIX didn't spike. We're in contango in the marketplace. Nothing going on right now is leaving me warm and fuzzy that we're anywhere near a bottom. And I'm not saying that to be, the bear, okay? Listen, do I have bearish positions on? Absolutely, unequivocally, yes. Day like this is kind of my day. Even though the S&P's actually rallied back up, it's still my day. Nevertheless, okay, forget about what you think a bottom even looks like. At this point, markets absolutely are on the verge of a much greater crisis. Starts with liquidity. Okay, there's not much clarity to what is actually going on, okay, underneath the marketplace. And at this point in time, sell some premium, get back, get hedged, stay alive. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.